So we are going to switch topics now. We're going to go to the market and talk about trends, timing, risk, opportunities. For anybody just tuning into the video, this is Fort Pitt Capital Group. We are talking on April 8th, 2020 about the market. Dan, I'm going to stick with you on this question. How does the current steep decline from equity market highs in February compare to the equity market declines over history?
Well, another good question. So certainly not the steepest decline in history, but it was a record setter, in a number of ways. It was the quickest decline into bear market territory in history, with the S&P falling 34% from peak to trough, and that occurred from March 19th February 19th to March 23rd. So a very rapid decline, and also the worst first quarter for the S&P and the Dow in history.
To piggyback on that, the parallels of the downturn, really I think what everybody wants to know is it going to be as bad?
Okay, good. Another good question. So I'd say one of the parallels or similarities from my seat was how the fixed income markets, or specifically the credit markets, behaved, at least initially. We saw the investment grade corporate bond market, the index, down almost 22% from peak to trough in about 2 weeks. High quality, firmly investment grade, municipal bonds index down 13% during the same time period. Some of that was investors really reassessing the credit environment, given the expectations for significant near-term economic weakness, and some of it was just the sell everything mentality and a liquidity grab, I'll call it. As we mentioned earlier, the fixed income markets, the credit markets or environment has improved a large degree since that mid-March time period, and after the Fed really stepped in decisively. But that period specifically certainly did remind me of the financial crisis environment. But some really important differences as well. And I think these really point to why we don't think it will be as bad or long lasting as 08 or 09. But consumers are not as levered as they were back in 2007, heading into the financial crisis. And they've dramatically repaired their balance sheets since 08 and 09. And I think we can really say the same thing for the banks. They're not leveraged up 30 to 1 like they were going into the financial crisis. We expect, and we think we're seeing, so far, it really points to the banks being part of the resolution or the solution here, being able to facilitate lending to consumers, small businesses, and corporations. And then my final point would be, I just think we have a better roadmap or line of sight, or I think Charlie might have even called it a blueprint, for how this economic downturn ends. And we certainly didn't have that in the depths of the financial crisis.
For sure. Charlie, I'm going to go to you with this next question. There seems to be a sentiment from the clients that indicates things like they assume that we've never seen anything like this before, and it's never been this bad. Can you speak to that, and maybe how long that recovery might take, and be a student of history for us and talk about this compared to other things that we've dealt with in the past?
Well, to do so, I'm going to have to give away my advancing age, but I guess that's okay. People, every generation wants to think that the crisis or the period that they lived through is the most significant in some ways, but certainly we've seen periods like this. To me, the 1987 crash in October 18-19 of 87 was just as rapid, or nearly as rapid, as the one Dan described a few minutes ago. So we have had periods where the markets have collapsed this significantly. Certainly, the rapidity of the decline indicates we were all sort of collectively surprised by not only the severity of the pandemic, but really importantly, the sort of draconian public response to it as well. I think that's really what caught people off guard, was how rapidly so many states just completely shut down business activity over the space of a weekend. So this has made the sudden magnitude of the economic shutdown even more stark to people. And I think that's what's really catching people off guard, and what caught the market off guard. In a sense, we've jammed a whole sort of depression's worth of pain into 3 or 4 months. And to my mind, the good news is that sudden drop implies perhaps a quick and sudden rebound once we figure out that, hey, we've got the worst of the problem behind us. We're learning how to adapt as human beings, because that's what we do. And we're going to emerge from this, induced coma, as I've mentioned before, not all at once, but in a staged fashion that allows us to get back to normalcy faster than most people think.
Great. So the next question is going to be for Dan. Dan, we wanted to find out from you when you think that you're going to start to see that extreme volatility in the market start to subside.
So first, I'll just start by touching on volatility levels for a minute. And we saw equity market volatility levels surpass those at the peak of the financial crisis, and really rival the volatility levels that kind of Charlie mentioned back in the 1980s. So it really has been a wild ride in any context. Now we have seen the volatility index, and in financial markets there's an index for everything, but that index has declined by about 45 or 50% since the middle of March peak. So that could be a sign that things are calming down to some degree. And not that we make any investment decisions based on it, but I do tend to follow, or at least keep an eye on, certain sectors of the hedge fund world, and a lot of these, kind of trend following, momentum based strategies and how they're positioned. And I think it's important to mention, these aren't strategies that are making long-term fundamental investment decisions. They're following trends, they're chasing market momentum, etc. But there's certainly a ton of capital allocated to these strategies, and they tend to move markets when they flip from buy mode to sell mode, or vice versa. So looking back at how they were positioned coming into the sell-off, back in the middle of February, they were very aggressive, very bullish, carrying much higher than average levels to equities, to stocks. That's definitely changed. From the middle of February through the middle of March, they shifted from very aggressive to very bearish, and are now holding much lower than normal exposure to stocks. So I think the point being is that we think that a lot of the volatility was exacerbated by this move from these trend following strategies. And maybe the most important point is that maybe the majority of that selling pressure is behind us, since so much selling has been done already.
Excellent. We're going to switch topics just a little bit here in the same segment here, but we're going to talk about dividends, and we're going to go to Charlie on this one. Several foreign companies, mostly banks, have suspended shareholder dividend payments. Some U.S. firms may be forced to do the same. Clients would like to know, how safe are their dividends?
Well, dividends are really the core value that you expect out of an investment. Investments are the discounted value of all future cash flows from a business. So dividends are important. Managements know they're important. As you mentioned, we've seen a whole slew of companies in Europe, particularly banks, who never really recapitalized themselves as well as they should have after the last crisis, cutting their dividends. But the key part of the answer here is that the number of U.S. companies that end up cutting their dividends is going to be dependent on the length of the national shutdown. The longer it goes, the more the odds of cuts by individual companies increase. Those companies that are more financially or operationally leveraged are more likely to cut. That said, there's no typical profile for a dividend cut. Any company that takes a government bailout is obviously going to be cutting its dividends because taxpayers are not going to be want to be funding dividend payments. So that's probably an obvious one, but you probably won't know that a dividend cut is coming soon enough if a company's taking a government bailout. It'll happen almost instantaneously. Some of the industries that are most likely to be affected by dividend cuts include travel, cruise line, hospitality, hotels, airlines, domestic oil and gas production, because we have seen a huge decline in the price of oil along with the COVID-19 epidemic. So those are some of the industries where we would expect to see the number of dividend cuts rising.
Great. The next question is about bonds. We keep hearing that there might be problems with bonds. Dan, can you address if bond funds are going to be okay through this?
Sure. So our primary focus is on high quality investment grade corporate bonds, high quality municipal bonds. So, less stress than other segments of the fixed income universe, such as high yield or certain segments of the energy market. But, as always, it's critically important to do the credit work, to do the credit analysis, and to know what you own, which we're doing in this environment and every other environment. And that statement really applies to whether you own individual bonds or bond funds. But I think an important point to mention too, and again, not that it necessarily applies to our fixed income investment process, but again, the Fed's recent actions have certainly helped to, relieve some of the liquidity issues and stresses that we saw initially in fixed income markets.
Let's talk about that a little bit more. With interest rates at or near zero, how do you get a yield out of a bond?
Yeah, I think that's an excellent question, and there's a lot of different ways or directions that I could take that question, but I think it really plays into the tough decisions that a lot of investors are grappling with. Not just us as individual investors, but institutional investors, pension funds, and endowments, et cetera. How do you meet any, I'll say, reasonable, long-term return objectives in such a low interest rate environment? Do you accept those low returns and those low yields, or do you accept the volatility associated with stocks in search of higher returns? I think the situation really, or that question or that dynamic really highlights, what the Fed's doing and which direction they're trying to nudge investors towards. I think it's really important, but very difficult to meet anyone's goals with a 0.7 or 0.8% yield on a 10-year U.S. Treasury bond, and that's not even factoring in inflation or taxes. So we don't have a magic solution for the problem, but I think it's a good example of why it's so difficult to turn away from or to shun growth assets like stocks. Maybe to answer the question a little bit more directly, right now yields on high quality municipal bonds look fairly attractive compared to what we're seeing in the Treasury markets. The same could be said with investment grade corporate bonds compared to treasuries or government bonds. But again, those are all comments based on relative attractiveness. So, no silver bullet here, but we think that a balanced approach, which is one that's in line with an investor's goals and objectives and risk tolerance, is the best solution.